Hello, this is Ed Butowsky with ChapwoodFinance.com, and I'm thrilled to have John Serrapere with us today from Arrow Insights, one of the best research analysts, one of the best money guys out there. And what I want to do right now, John, is jump right into the discussion, because what is very important about some of the work that you do is you come out right out from the very beginning and say that people look at diversification the wrong way when they're looking at portfolios. So please, can you tell us a little bit about how people are looking at diversification the wrong way?
Well, what has taught us a lot about diversification is that in 2006, we really hit what I call peak risk rather than peak prices. And that's where credit and real estate basically reached its peak leverage point. So what they need to really look at is risk factors, diversification among really credit risk, default risk, and inflation risk.
And when you're looking at that, I mean, in portfolio management, and we all know that real estate just got killed and everything went down with it. I mean, the whole world at that one moment lost a lot of value. There were actually some hedge funds that actually did very well. I know some that were up actually in 2007, 2008. But generally speaking, we never saw a time period in the history of our country, from what I can tell, where everything went down simultaneously at such a ferocious pace. What lessons do you think people have learned from it? And doing what you do as a research analyst, what could you advise clients to do right now to avoid that problem?
Well, what they have to understand is when you look at a credit risk or default risk, when it's discounted immediately because companies go out of business tomorrow. Whereas when they discount inflation risk, they discount it over time because inflation doesn't come tomorrow, it comes gradually. So most asset allocation models and Sharpe ratio models and mean reversion models for diversification, they're working off the inflation period. Stocks and bonds and asset classes work off a certain return correlation matrix when inflation is the primary risk. But when defaults risk hits, correlations could everything goes to one in a heartbeat.
Yeah.
Things go down together.
Good point.
And a few other factors that come into play, but your horizon for loss shortens.
That's a great point, because everything did do that. Now, default risk, given that we have been, given the opportunity to see a lot of printing of money, people tend to forget about the default risk right now, and I think that default risk has, become much less than it was, back in 07, 08. Do you agree with that? And what do you see as some of the great risks in the market today, as of February 21, 2013? What keeps you up at night?
What keeps me up at night is that the default risk has been handed off as future inflation risk by the risk being transferred from the private sector by monetary authorities and government authorities to the public sector. So the future taxpayer and everybody that is least responsible for the risk of the crises is going to be the payer through higher inflation, higher prices. We're going to be running through rebouts of acute default risk and inflation risk, but I think eventually we'll come out of this with high default risk being dissipated and the defaults coming more in terms of cheaper dollars.
And with this, where is the opportunity in the markets right now?
The opportunity in the markets is to use the default risk cycles to buy inflation hedges, such as gold is now correcting, because we're getting a rebound of what we call the default risk premium coming back in the last 3 or 4 weeks. This cycle will be short because I believe it's end of July 2012, that the primary risk as the inflation risk premium has returned. Because in July, the ECB and Draghi, the Bank of Japan, the Federal Reserve, they all said they would have unlimited quantitative easing with no horizon on end. Prior to quantitative easing announcements, all had a term. They had a fixed level where interest rates would stay low, and they were pointing to 2013, 2014. If you notice, they all simultaneously said they would do whatever they would do to support the euro.
Absolutely.
Bernanke said the opposite, which supports Draghi. I'll do whatever I can do to trash the dollar, which is the opposite inverse effect, is helping Draghi support his recovery. And Japan basically is devaluing the yen, which is inflationary eventually in Japan.
Yeah, it's almost like a race to the bottom as to who can get low to make their exports that much more attractive. I mean, that's basically what everyone's doing. I don't know when this is going to end. I mean, I was speaking to someone the other day in Hong Kong, and they said, "Look, we don't have any problems over here, but the rest of you guys, you're a mess."
Well, they're going to come out of this smelling better because they have the least amount of problems in terms of debt load. But actually, I'm not a newcomer to this cycle. In 1997, I had been publishing what I call these New York articles for Thomson Reuters. In 1997, I wrote a piece that said the coming decade would look more like the 1930s rather than the 1990s, because I saw some of these cycles coming on. Because remember the competitive devaluations that occurred in the late 1990s, with China devaluing the yuan and the Asian markets devaluing all their currencies. They did that to lift themselves out of that crisis that we had. We had a major crisis in 1997, 1998. We had the Thai baht crisis, multi-currency crisis, 60 to 70% declines in Asian stock. We had the peso crisis in 1994. Well, we had all these crises, the LTCM, and each one there was a bailout. And all these bailouts, they led to everybody saying, hey, eventually we'll all be bailed out. So that led to the major banks and all the investment banks saying, let's all become like LTCM because we'll get bailed out.
That's right.
And the governments, they've all become hedge funds.
Yeah.
Okay, our central bank is $3 trillion, they're a hedge fund. ECB has $37 trillion in debt, which most people don't realize, versus $3 trillion in US. That's a huge hedge fund. The only way out of it is to print money and take risks and to make the dollars cheaper to pay back.
Well, as we close here, do we see inflation with all the printing of money, which we're all in agreement is going on, or do we see deflation? I mean, there's a lot of people out there that believe that we're not seeing the signs of any of this working, and at some point we're just going to see a deflationary environment. Where do you lean?
I don't. You really haven't seen much deflation in spite of what we saw in the past. We were on the brink of the Great Depression, yet we only saw about 8 months year over year where we had deflation. That was the first time since 1951 we saw it. But you remember, they always kept inflation relatively positive, low, between 1% and 2%. So every time we see a default risk cycle, they'll lift us out of the low inflation for higher inflation. But the big risk we have is even if we just see 3% year over year inflation, treasury yields will jump. They'll jump from where they are now very quickly because everybody is a hedge fund. There's no safe yield. Everything has a long duration. There's no safe yield. When you see year over year inflation of at least 3 to 3.5%, 10-year yields will jump quickly to 3.5 to 4%. And there'll be huge losses with bond investors.
Yeah, and it'll probably find its way over to the equity market. So
yeah, more and more money will then be printed and flow into risk assets.
Well, I'll tell you, John, I really appreciate your time. You're obviously very knowledgeable, and I like to continue to call on you from time to time to give your insight. Where we become almost genetically negative with everything in our world as the stock market continues to go higher. But I'll tell you, you pay a dear price for consensus on Wall Street. And I've been at this 26 years. I know you've been at it a long time as well. We're in very uncharted territory right now.
Yeah, can I show you a picture real quick? It's a piece I wrote in May 2006. And what you see credit risk is contained at the bottom of the ocean.
Can't see it too well. Put it up by the camera there. No, closer to the camera. Okay, I see it now.
It's inflation that's in that container.
That's inflation. There you go.
It was credit default risk that was in that container when I published this in 2006. Now I'm concerned it's inflation risk that's sitting at the bottom of the ocean. When that breaks, it's going to pollute the economic seas.
I love it. And don't publish that because I'm going to steal it now.
It's rough waves for investment cycles.
There you go.
Just much higher volatility than you have now. You only see low volatility when there's a lot of liquidity and low credit spreads. When this thing unwinds, it'll unwind with inflation and higher credit spreads. There'll be nowhere to hide.
John, you have a good weekend. Thanks for joining us. And again, I'm looking forward to calling you again and having another interview a couple months from now.
Right. Thank you.
Thank you.